Good morning, Excellencies. Good morning, ladies and gentlemen. I am a Principal Investment Officer of IFC, the International Finance Corporation, the private sector arm of the World Bank, and I'm based in Istanbul, covering Northern Africa and Middle East, but also Eastern Europe and Central Asia. I would like to talk to you this morning about trends in debt and equity investments in the mining sector. And for starting with this, I thought it might be best to just give you a brief overview of who the International Finance Corporation is. So you have on the left-hand side essentially the two institutions, IBRD and IDER, two group companies that are primarily interacting with member governments. There are some 187 countries that are shareholders of IBRD and IDER. And then on the right-hand side of the slide, you have the two institutions within the World Bank Group that are dealing exclusively with the private sector, i.e. we are investing in companies that are developing projects in emerging markets. So as such, IFC is promoting the private sector as a basis for promoting employment and generation of income. And we are doing so by providing equity investment and debt financing, and also providing advisory services for helping to building capacity knowledge transfer. IFC has been around since the mid-1950s. We have an asset portfolio of about $45 billion. We are committing in new business annually across all industry sectors about $15 billion in new business. IFC is still one of the institutions that is benefiting from a AAA rating, which is certainly facilitating also the raising of funds for us as an institution, which then will be provided either as debt or equity to our investee companies. We are not taking sovereign guarantees. As I said, member governments are shareholders in the IFC and thereby provide and give us access to member governments. IFC is very much standing on the forefront for international best practices being applied to its investee companies. This is particularly related to, and I will expand later on this, to having the best standards in terms of environmental and social applied to their projects. On the mining side, we are an institution that is investing fairly early on in the mine life cycle. From relatively early exploration, we typically do not finance the grassroots exploration and the geochemics and geophysics. But once a discovery has been made, we are willing to take the risk to actually prove on whether this is economically viable. And we would then ongoing financing it through the various feasibility study work that is necessary to making it a operational mine. We also finance mining expansion projects and the processing of all sorts of metals. In terms of portfolio, IFC has had a portfolio of $730 million, roughly half in debt and equity. This is representing 34 projects in 23 countries. If you look at it from a commodities perspective, we are very strongly focused on gold and iron, but also copper and nickel. This commodity repatriation is by no means by design or by any kind of internal policy standards. It's more the reflection of the opportunities in which we were able to be investing in the last couple of years, which was largely with more junior mining companies and it may change dramatically if another project, say in one of the other commodities not currently represented here, would be added to the portfolio. In terms of geographic spread, it's mostly sub-Saharan Africa, and we have heard His Excellency talking earlier about the relevance of Africa as a primary source for natural resources, hopefully not only for supply of those, but also in the future for consuming much of it by themselves. Latin America has traditionally been the second strongest foothold. The Northern Africa and Middle East region, in terms of mining portfolio, in my view, is still an area to grow, and this is one of the reasons why I'm very pleased to being able to speak to you here today. In terms of IFC added value in mining, IFC is taking a very long-term perspective in terms of providing funding, either through the equity or the debt part, but we can provide maturities which are significantly longer than those provided by commercial banks for most of the emerging market countries. And we serve essentially as a catalyst for financing, meaning that other financial institutions, private equity funds, take great credibility about IFC's presence in an investment and therefore would be willing to join. It's also one of the reasons why commercial banks then typically take some comfort in IFC's presence. We combine the local knowledge through our different projects that we have invested in the emerging market on the one hand side, and combine that with the global expertise that we have in the mining sector. In terms of country risk mitigation, as I said earlier on, IFC is playing a vital role in mitigating some of the political risks related to regulatory unclarities at times, but also in negotiating with governments occasionally on some of the projects if there were to be elements that would uphold the development of the mining sector. As I mentioned earlier on, a very strong foothold is IFC's expertise in environmental and social standards, where we would want to ensure that communities benefit from the long-term sustainable development of mining projects, and where we would see that local employment is generated as part of the supply chains, and I'm going to come back on that later on. Let me just give you also a perspective of the global trends in mining. Where do we stand? First of all, I think we should start with a global view on demand and supplies. And while there has been at many of the previous conferences that I've been attended always been reference to the super cycle. While certainly the demand of China is still impressive and potentially oncoming demand from countries like India, but certainly also many others like Indonesia and countries in Africa, I believe there will still be significant demand for commodities. But with the tremendous investment in the industry also over the last 5-10 years, we see for the first time in this present cycle that there is an oversupply of some of the key commodities. And these oversupplies will have to be absorbed by the market. And that's one of the key fundamentals driving current commodity prices, which are still stronger when you look at the commodity prices history than they were for many years in the past. So it's more an increase in additional demand, which is diminishing, despite all the still quite significant increase in commodity being used in the build-up of emerging market countries. But we also have to acknowledge that production costs have been well and are well beyond all previous levels, and this is squeezing margins and thereby making some of the projects that had been built to become more marginal. And that will be another trend that we are anticipating to increasingly to come, which is that the marginal projects will find it increasingly more difficult to actually finding financing for. So with the commodity cycle turning, and thereby with, well, and turning to a degree, it is not just that there's a slowdown in demand, but there's an oversupply. We see exploration funding falling dramatically to the extent that in many markets, at least in the traditional markets like Canada and Australia, it is almost impossible to raising any exploration funding in the present environment, unless you have a very strong project that gets developed. So, based on this, shall we ask, are we back to the normal cyclicality that we have always noticed over decades in the natural resources sector? And what is the industry doing about it? And I think what is interesting to observe on this chart is, which is essentially comparing the performance of the mining sector relative to the performance of the global equity markets. And if you look at it from a period from 1970 to 2000, it has been a period where the mining sector underperformed the MSCI by about 60%, with a short interruption, which was in the mid-1970s, where gold prices reached $800 per ounce. Following that period, since 2000, only within 8 years, the mining sector outperformed the MSCI almost 6 times. So there has been a tremendous swing upward, which then was now followed since almost mid-2011 by a reversal of almost 70% of this upswing of the six-fold outperformance, which took almost 8 years to build it. So we are now just below the long-term 50-year trend. And so one could ask, well, is the worst already over? And there are some analysts who are saying, well, yes, that's indeed the case. I hope for everybody in this room that we are not going to go back to the levels that we had at the turn of the century, which would mean that there would still be quite some room for additional adjustment to even present levels. But let's take the confidence out of emerging market growth rates, but also the improving situation in the developed world, namely the US and to some degree also Europe, that demand will stay relatively robust, and therefore the ongoing impacts on the commodity prices will be moderate and gradually see again an upswing once the oversupplies, the period of oversupplies is to be overcome. Coming back to how the adjustments are going to be made, on the one hand side, we would expect, and we have seen that happening over the last 18 months, almost 2 years now, that there have been quite significant changes at the management level. We have seen many CEOs, COOs, but also the middle management changing from many of the mining companies. Cost control, again, is very much on the forefront, whereby a much more rigorous selection project to develop is applied, and the capital employment and allocation is rigorously reassessed. Mining plans are revisited. Priorities are given again on commodity grades in order to optimize production and thereby economics of the mines. All this is largely leading to optimizing cash flows and shareholder returns in order also to keeping the industry sector attractive for third-party investors. The financial adjustments, I've briefly mentioned that earlier. Equity is much harder to find, especially for exploration companies, and I think this is also a great opportunity for markets outside of the traditional commodity financial resource financing centers. Just to name 2 of them, Canada but also Australia, to position themselves as a source of funding for developing the next cycle in the commodity business. There are many listed exploration companies that have barely sufficient cash to administratively survive. Not to speak about that they would have money left to be spent on additional exploration, and thereby having money that could ultimately help building momentum for their own stock price. So what I anticipate is needed is a consolidation, and a very strong consolidation of juniors where you have still a group of juniors that still have cash left, but maybe not the strongest mining assets to be explored. And then you have others that have no cash left, but have very strong assets to put into operation. Further exploration is required before then a development decision could be taken. So putting these assets together is certainly one indicator how this industry, particularly on the juniors, could adjust. I also anticipate that some juniors will just simply disappear, and licenses would become available to be relatively cheaply picked up by others who are then keen on developing the next pipeline of strong exploration assets. I also would expect that there's more mid-tier companies to emerge from competition for better quality assets. This comes back to building up profitability and thereby sustaining shareholder value. And superior management and market proximity will be drivers for defining which of the mining assets long-term value generators. Another perspective of looking at it, and I won't spend much time on this, is actually the free cash flow ratio that mining companies have available to either fund acquisitions or for investment in the development of their assets. And here we see that particularly for juniors who have spent significant cash out of their operating cash flows, it is becoming increasingly harder for them to continuing the way they had been operating in the past. Implications? Well, mining companies have a choice on where they want to go and where they would want to invest in, either in exploration or with whom they would want to partner with. I mentioned the need for consolidation. There's also a very strong necessity to creating a cost-competitive and efficient mining regulation, and I think that's also an aspect that regulators should bear in mind when, in the past, when we had a very strong commodity boom, there was a tendency by some governments to increasing their relative share in the overall return and profit of certain mining operations. To rethink that strategy and to also consider the view of how important the industry sector is as such for the overall development of the country. And therefore, on whether there should be also, there's more reason now that the commodity cycle is not booming anymore that strongly as it did in the past, to think about building incentives that would actually be conducive to additional investment in the industry sector. Because one thing is very clear, without exploration, there will be no future mine to build. So there's an absolute need for building this pipeline of future mines. The demand, as many economists have always pointed out, will come and will be there in the next decades. It is less certain on where the next generation of particularly large-scale mining is going to come from. But I also would want to ask, what is it that the industry could do better in order to avoid the typical boom and bust cyclicality that we have observed in past cycles? Because while that cyclicality has huge and severe implications for all stakeholders involved in the mining sector, the companies themselves. They may just simply disappear. It's employees who are then affected, governments who will not get their fair share of royalties and taxes. And even more so, and I think that's even more prevalent, the implication that the boost and bust times have for local communities who are very much depending on these projects to finding jobs, and not just direct jobs in the mines, but also in terms of all the services and goods that need to be provided to the mine, and thereby help building up local supply chains, and thereby developing small and medium enterprises next to the mining projects. I have to conclude a few more slides on more generally what types of funding sources are available other than just the traditional equity capital markets, private equity financings, debt capital markets, and bank financing. I guess that beyond what I mentioned or referred to earlier on, joint venture and M&A activities, there will be more debt instruments coming up in the future to finance the next phase of mine development going through the cycle. Global development agencies like ourselves will play a significant role in financing commodities, but also offtake arrangements will take a significant part in helping to raise equity funding or debt funding in that process. And I think there might also be some thoughts about whether governments could support the development of the next generation of strong mine developments. I have referred to, and I won't go into detail into this, IFC is providing essentially the whole range of financing products that are necessary at any stage in the mining cycle to help develop that project through the mine life cycle. I think what should be highlighted is that IFC typically wants to be a long-term partner. We are investing for the long term, meaning at least for 8, 10, sometimes even well beyond that time frame, certainly on the equity side. There's no mandatory exit mechanism. We are typically taking 5 to 15% in the equity of a project. But in any event, we wouldn't want to become the single largest shareholder. For debt financing, IFC is providing up to 25%. This is reflecting the idea of being a catalyst in the financing, not the sole source of funding. And we want to be really seen as a long-term partner providing solutions to all dimensions of the project itself. Fundamentally, certainly for providing international best practice on environment and social applications within the mining operation. IFC's presence in the financing contributes to the raising of the client's international reputation and reassures stakeholders. In summary, it will all be about continuing to developing high-quality, robust, and low-cost projects, as there is an ongoing change in the long-term demand for commodities. But altogether, projects will have to follow a lower cost and risk profile in order to attract financing. We have to recognize that the credit and capital markets are looking for significantly more de-risked projects. Lenders would want to see higher equity stakes, so I can only recommend everybody to raise it early if you can find it at all in the current environment. One also should expect pricing to depend very much on the general features around these mining projects, and project financing could be one viable source of funding in this context. I would like to thank you very much with this, and I'm certainly happy to taking any questions.